Well, hello, everyone. Thank you for joining us today for another episode of Two Economists and a Lender, where we take that deep dive into the most important economic issues facing agriculture. I'm your host, Carly Jacobson. Today, we have David Widmar, Brent Gloy back with us from Agricultural Economic Insights, along with our lender expert, John Hanssen, who's a financial services officer out of Southeast South Dakota. Today, we're talking about how to calculate return on investment, the benefits, the limitations of the metric, and the role it can play in your decision making. So, as you listen today, be thinking about where you might calculate ROI in your operation and what data you might use to calculate the value. All right, Brent, why don't you take us away?
Thanks, Carly. Welcome, everybody. As we thought about different topics for the webinar series, one of them that came up was return on investment. And it's fit really well with my interest because it's one of those things that I think gets talked about a lot and is probably the most poorly defined, poorly understood measure that is used in kind of ordinary jargon. Return on investment is a really popular phrase. I mean, people use it all the time. If you just listen to them, well, that's got a great return on investment. So it's very popular. It can also be pretty darn insightful. We can learn a lot from it, and it's intuitive. So it's, usually these things we use a lot, or they have some merit to them, but it also has some limitations. And one of the most popular ones, I would say, the other bullet we could put on here is really popular in marketing. So you get marketed to things all the time and say it's a great return on investment. And if you bought all the things that are, the advertisers you see said would save you money or add yield, well, we all know where we'd be. So what we wanted to do today is just talk a little bit about return on investment, help you kind of understand what it is and how to use it wisely. So I want to start with just a poll to see, what you're thinking. And if I told you is a 10% return on investment good, not enough, or we need more information? Good. So probably, you would have known this before, but also from the tone of my introduction, you might have the feeling that maybe we need a little bit more information to evaluate that. And that's what I think I would say to that. Now, we can argue about target levels and all that kind of stuff, but we'll get into that in a second. So let's go ahead and just start by thinking about how return on investment is calculated. Now, I don't know. I taught finance for 20 some years at the university, and I don't know why this occurred to me today. Yesterday when I was thinking about this, but it's return. I wonder why it's called return on investment. Well, if you think about the formula, return sits on top of investment, so it's return or profits divided by your investment or your costs. So what we want to do is calculate up what the costs of that investment are in terms of how much we put into it, and as well as see what kind of return we get from it. So therein lies the appeal. It's pretty simple. All of us can kind of visual or understand what are in those two components, what we put into the investment as well as what we get out of it. Is really helpful when we start thinking about uncertainty or comparing alternatives. So, for instance, if we have an investment that returns 20%, one that returns 10%, we're getting twice as much return from the 20% one per dollar of investment. So it can be helpful when comparing alternatives. But therein also lies a little bit of a challenge because sometimes that investment dollars could be drastically different. So you might not want to compare ROI for, say, a crop input with the ROI for a farmland investment, just because you're talking about such vastly different scales. Now, the formula is done to kind of account for that or normalize it, but we have to recognize its limits. So we just want to recognize limits. It's also used for looking at performance over time. So what we wanted to do is just give you a couple simple examples of how you might see this used in your kind of, I think, ordinary life as the normal course of business. As a farmer, we see lots of these kinds of things. So let's take an example, David, of a fungicide.
Yeah, and this is an example that a lot of us are probably familiar with. We might, it seems like ROI is often attached to some of these inputs. And so we wanted to share this. This is an example, so don't take this and apply it to your operation, but it's a way for you to think about how you might have seen this or how you might see it play out. So with fungicide has a lot of uncertainty, right? Sometimes it has a big return in the form of a big yield boost, and sometimes maybe it's an average. So I have three scenarios here. Scenario 1, 20 bushel increase. Scenario 2, 10 bushel increase. And scenario 3 is about a 1 bushel increase. And so that creates additional revenue for your operation. And so we assumed $4 a bushel for corn. And then we looked at the cost of applying the product and the application itself. And so you could see we start to have the beginnings of this ROI under these three scenarios. And this is helpful because there's some uncertainty as to how this will play out, given the weather and the disease and the timing and all these issues. Now, we could also maybe assume the frequency of these outcomes. And so we can say, okay, this best case scenario happens 25% of the time, the worst case scenario happens 25% of the time, and about half the time we get, a decent response, but, kind of close to a break even. So then we can weight all those different ROIs and we say, okay, there might be a weighted average return here of about 11% for this ROI for this fungicide application. And so one of the things we want to point out here is that this is just one of the ways of measuring this. And so what you start to see here is all of the types of assumptions that had to be made to get to this. And what we often see is we hear the final number at the bottom of, oh, the ROI is blank. And what we really want to encourage you to do is step back and say, okay, what are some of the assumptions that you have to make to get to this outcome?
And it's funny, David, because oftentimes as a farmer, I get approached with these things and say, well, what kind of an ROI do you want for this kind of a thing? I'll say, like 100%. And they, what? How can you expect so much? And well, there's a lot of risk here. There's a lot of other things that have to happen and go right for this to work. So I expect for that kind of thing, I want a really high, ROI, because you're probably giving me the favorable, situation. So I think, it's a good example of, understand what that uncertainty is as you do it. Now, for something like farmland, no, that's not the case at all. You can't expect that kind of return on that big of an investment.
And Brent, one of the other things we want to point out here is that this is sort of a marginal analysis, right? So we looked at all the marginal additional revenue and all the additional cost. And one of the things to consider is that, this wasn't maybe all the cost that it took to bring this corn plant to this stage of growth. And so what you also have to maybe consider is, what do you put in the denominator for what are all the costs? Is it the marginal cost, or is it the total cost of getting here? And so it's one of those situations where 2 or 3 or 4 or 5 people in a room probably would calculate this all a little bit differently. And so you just need to recognize that up front and ask good questions if someone is giving you that information. But then secondly, create sort of your own internal operating procedures of how you want to calculate this and how you want to approach this and what makes best sense given your goals and your objectives and your preferences.
And I think that's the most important thing. In order to interpret an ROI, we have to know what goes into it, because it's almost guaranteed no two people are going to calculate it exactly the same.
We think it's important to go beyond just the reported ROI. Sort of ROI for a lot of us should be the starting point of sort of our investigator hat, right? Thinking about how do we untangle some of this. So one of the questions we might get, or you might think about, is X% ROI sufficient? And oftentimes that isn't the best way to frame the decision. We really want to step back and say, how good are the assumptions that I put into this, you can really really question some of those assumptions of, how frequently would that best case scenario for the fungicide play out. Maybe do I know information here in 2021 that I should change those probabilities based on information that we can glean. The third point here is how skewed are possible outcomes. And so if I told you option A is 10% and option B is 10%, you know nothing about the range of possible outcomes. And option A might pay 10% every single time. Option B, on the other hand, might pay you 100% ROI one time and a negative ROI every other time. And so I like to think about this a little bit in terms of lottery tickets and home insurance. First of all, none of us buy home insurance because it has a positive ROI. None of us are hoping for a huge return to those policies we pay out, but we do it because it offsets a really bad situation that we're trying to uncover. The other one is on lottery tickets. For 99.9% of us out there, the lottery would be a negative ROI activity, but there might be reasons why you might do that. One is the payout is really huge. And second of all, if Brent calls me up and says, hey, David, will you go in on this lottery pool with me? I'm always going to say yes, because it's a pretty low monetary investment, just a couple bucks. And I don't want to be here on the next webinar and explain to you why it became one economist in the lender. Brent hit the ticket and he's off in some Caribbean island. So I want to make sure that I don't miss out on that. So ROI is a helpful measure, but it's not the only thing that we should be thinking about when we approach these decisions. And the fourth point here is going beyond the ROI is it's a framing situation. So the ROI I showed you in the last case was this return of doing nothing, right? So this idea was you're going to do absolutely nothing, or you could use this example of a product, when in reality, we always have to think about, okay, what's the ROI on alternative fungicides? Or what are some ways that we can reframe this question to make sure that we're approaching it in a way that makes the most sense for how we're considering the decision itself? I think oftentimes one of the ways you can really create some confusion maybe in the marketing is the framing of these debates. Is like, if you're going to get X% yield increase, well, what's the alternative? What was the base case of, okay, if there's a disease out there, yes, I'm going to do something. I'm not going to sit there and do absolutely nothing. And that's important to consider. The next thing we want to talk about here is the idea of benchmarking with ROI and how we can use this in a way that's comparing alternatives. And so one of the ways, if we might think about investing in more farmland, ROI can be really helpful to think about, well, what's the best return here? Because Brent mentioned this earlier, but farm A might be dryland, which costs $6,800 an acre, and farm B might be irrigated, which is $9,500 an acre. Now, you're going to have to think about what types of returns you can generate that from your operation, but ROI can be very helpful for comparison of like item things. So kind of an apples to apples comparison as to which one is going to get the highest return, because definitely the returns and the costs will be different for dryland versus irrigated. So this allows you to sort of line them up to create some meaningful comparison. The second way this could be really helpful for benchmarking is calculating your farm's return on investment, especially over multiple years, maybe a 5 to 10 year average. And this could be a very valuable measure for you to think about, okay, how has my operation been performing? What kind of growth might I be able to expect, especially if we're thinking about maybe a next generation or making future plans and making future objectives. And finally, different benchmarks are needed for different investments. And so going back to that first question, the poll we had for you, that's one of those polls where everyone answered right. So I'm sure a lot of you were thinking about a specific investment where 10% would have been really strong, like maybe farmland, especially if you can maintain that over your entire career. On the other hand, some of you were thinking about, like Brent said, maybe I want a higher ROI for this type of input that has uncertainty in the type of outputs it might, or the type of outcomes that might come. So we always want to make sure that people don't approach you and say, hey, this is a pretty high ROI, you should just do it. Well, you have to consider, how should I benchmark it for this particular decision and this classification of things I'm considering? So the last slide we have here before John joins us is an ROI checklist that we've pulled together. And there's just 4 sort of ways to get started. The first one here is to identify all the costs and potential revenue. Sort of start with a clean sheet of paper and sort of start mapping everything out. And you're going to start to find things that maybe you don't have the answer to right away, but start with that sheet of paper and capture all the things that are relevant to this decision. Step 2 is to evaluate the alternatives. Really challenge your thinking here to make sure that you've got the right frameworks for how you're considering the decision you're making between A and B, or maybe even C or D. Finally, 3, review the key assumptions and possible outcomes. We should always be critical of our assumptions and always be zeroing in on how those outcomes might vary based on new information we have or differences that might occur. And finally, we have to consider the constraints. And there's 2 major constraints we can think about as a farm manager. It's capital and labor. And one of the best examples is you can't invest in every opportunity that comes your way, but also you can't spend all your time doing all the activities that might have high ROI. So we can't do it all. And ROI can be a really helpful measure for helping us to prioritize what we might be doing next, or how we allocate that next unit of time or capital.
And David, I think those are all really good points. And I just want to reiterate a couple things that I heard you say in the last few slides, and that I think are really important. And one of them has to do when we're looking at ROIs is really understanding what that uncertainty is and what is our ability to measure that actual return, because sometimes it's really hard. So a lot of inputs are that way. It's really hard to kind of tease that, what was the impact of this input? And which is why I said, we really like to see something that has a demonstrable impact. And the other thing is that idea of skewness and returns, that the extreme returns, really good and really bad. And if we can find those things that give us, the chance for really big upsides and smaller downsides, those are really important things to look for and try to find as we're making our decisions.
So we now have the pleasure of having John Hanssen joining us. John, thank you so much for joining us for this episode. Looking forward to the discussion and the questions that we have for you. To kick this off, tell us a little bit about yourself. Carly introduced you a little bit in the bio, but tell us a little bit more about yourself and your role with Farm Credit.
Yes, thanks for having me today. My name is John Hanssen. I'm a financial services officer in Southeast South Dakota. So basically, I'm a loan officer, or directly work with farmers and their ag lending needs, whatever that may be, operating real estate or, other business ventures they might be involved in. So yeah, I grew up in Southeast South Dakota, went to school at SDSU and got a degree in ag business and a minor in agronomy. And then I'm also actively involved in our farm today. So that's what I spend my nights and weekends doing is when I'm not doing ag lending, I'm doing other, ag stuff and toiling with that.
Well, great. And I want to kick this off with sort of a hard question. And the question is, can you walk us through a really great example of how a farm might use ROI? And I know you can because you've shared a slide with us. So can you walk us through this example you've shared and also kind of hit us through some of the highlights of an ROI calculation?
Sure. Yeah, I'd be glad to. So yeah, one of the first ones we're going to look at here, and it's really been a hot button thing here in Southeast South Dakota where we're at the last probably 10 years, is drainage tile. There's a lot of land around us where, maybe 10, 20, 30% of that land is negatively impacted by excess moisture. So one of the biggest ROIs that we've seen over these past 10 years, not in 2021 where it won't rain, but, the previous maybe 8 years where we've been overcome with rain. So on average, say a farm like this, it might cost say $500 to do a drain tiling project. So if you would set that up, say you use zero cash to put into that and finance the whole thing on a 7-year loan, which would be pretty common terms for an improvement like that, about an $81 an acre payment. So regular returns, say that farm had an APH of 190 bushel previously. It would not be uncommon to see, somewhere in the range of a 15% yield increase. So, on those kind of numbers, 28 bushel an acre times $4 corn. So, a project like that, providing a fairly positive ROI. And the big thing is it's supplementing the cash flow, making that cash flow better than it was before. So in a lender's mind, projects like this are a really great investment. and something that's going to be there long term, versus, like a fungicide, where it's something you spend the money on and it's gone soon. This is a really great, long-term enhancement to an operation.
And I think what's great about the example you shared here is that you sort of got the back of the envelope calculations as a starting point, right? What are the costs? What are the terms? And how do I need to think about this over the life cycle or that I'm considering, right? So a lot of times we got to get a starting point for these calculations. And so this is sort of a good example of how producers might get started. So the second question I have for you is, so you gave us a great example, but let's back up a little bit and talk a little bit about how producers might use ROI in their operation. So we've calculated it, but how does this fit into the bigger management decisions that they make?
Yeah, so as you guys mentioned before, there's a couple of the really main things that we think of ROI is you have limited capital and you have limited time. So I've had I think we had a slide before. It said if I did all these things that offered a return, I could just spend unlimited amounts of money and all these things have a positive return. So in the lending world, we refer to it as leverage. How leveraged are you going to allow a producer to get? If you say I have a net worth of $1 million and I come to my loan officer with a list of $10 million of improvements, and they all, as advertised, have a positive return, I'd say, well, why wouldn't you finance this? This has a positive return. Well, so if you have a $1 million equity and you want to borrow 10 million, you'd have 8% owner equity at the end of that, or sub 10%. So no lender probably outside of the Shark Tank crew is probably going to borrow into that. So really you have to go through and prioritize what kind of investments can you make that are going to be high on your list for things that are really going to enhance your operation. And the biggest thing a lender wants to see is how is it going to enhance cash flow, because cash flow pays bills and keeps you operating. And the other thing is how does it affect your equity long term? Is it going to be something that's going to help you to continue to build equity, and is that actual investment something that you get to keep on your balance sheet as an asset? So maybe creating a plan, what are the things I want to do this year? What are the things I want to do next year? What are the things I want to do in the next 5 or 10 years? And how does that play into the next 30 years as to the assets that I want to invest in, and how they're going to enhance your cash flow and really create long-term income on your operation.
That's a really good point, that plan, and we've talked about that in other episodes about having that capital investment plan, or that plan of what's the top priority things that are really going to improve your return and on your farm, and having that plan figured out so that when you get the chance to do them, you can do them and not get sidetracked by maybe something else.
And like with an operating loan customer, when we sit down every year, or hope we usually sit down more than once a year, but I usually, one of my main questions I ask is what are your capital expenditure plans for the year? So if it's building a grain bin, or doing some tiling or updating a piece of equipment, it gets the conversation sparked, and a lot of my customers already kind of have their wish list already, but it kind of makes them disclose that too. And then and things come up, those plans have to be flexible, because sometimes an opportunity to maybe your neighbor across the road is doing a drainage project, and your drainage project was 3 years down the road, but now since he's doing his, maybe you move that up to number one, because all of a sudden it's more feasible, because that contractor will come in there and do it for cheaper. So yeah, it's being flexible, but yeah, I really do think it is important to write those things out and keep a list, because it'll help you, I think, stay kind of on track.
So you provided the tiling example, which was, very important for your area and other parts of the country. But what are some of the higher ROI activities that you've observed that might apply more broadly that operations should think about as they move ahead?
Yeah, so some things that maybe don't even require much money investment, and we talked about having limited time. One thing that us and most lenders offer now is like remote deposit capture, for not letting a $50,000 check be, stuck up on your refrigerator, sitting on the dash of your pickup for a week. I just calculated a 1 day's worth of interest on $50,000 that you should have deposited on your operating line, is $5.55 a day. So, it's something that cost you $0 to set up. And if you save 3 or 4 days, that's $20 in your pocket, and it really costs you nothing. And it takes you less time, instead of spending half the day driving around picking up checks and dropping them off at some physical location. So yeah, and setting up ACH, most I know the elevator ride deliver to, they offer ACH, so I don't even have to go pick up a grain check or wait for it 4 days to come in the mail. So just looking for things like that, and the deeper concept behind that is you have something more valuable you could be doing with your time. I guess if you're one of the rare operations that is never short of time, I guess maybe it doesn't matter, and you'd rather drive checks around than go fishing on your days off. But there's a lot of quick, easy, virtually zero investment wins out there that can help you enhance other things you could be doing.
So one other question I had here for you is, farmland, of course, is a big investment and a large share of the balance sheet. Do you see a lot of ROI calculations being done on land purchases?
I would say from a producer, a traditional farmer perspective, not really. Usually it's sort of an emotional thing, and a lot of farmers will point to the fact that probably every piece of land they've ever bought has never cash flowed or made a lot of sense the day they bought it. And the reason that over time it's worked out is, those assets continue to appreciate. We have inflation in our economy, which over time makes those look better. So most farmers are willing to, take income from other parts of their operation or off farm or wherever and subsidize that. From a investor or landlord perspective, it seems like most of that group probably at least wants to see enough income stream, hopefully to cover at least the annual interest cost and the real estate taxes. They may be willing to make the principal payment out of their pocket because they're still viewing it as an asset that's going to continue to appreciate and be part of their investment portfolio. And if they treat it like it's a 401k and IRA, well, that's something they may have to put money into to grow, because nobody else probably stuck money into their IRA either to establish principal.
If a producer came to you and said, I really want to get started on this ROI, and they want to roll their sleeves up on a project, I think a lot of times there's this barrier of the blank sheet of paper, right? There's this idea of, how do I get started? What do you think what kind of advice would you have for them to just jump in? How can they get started by jumping in?
Yeah, so I guess, depending on, the type of thing they're looking at, and probably depending on, their skill set and their background. We have a lot of producers who have, interesting backgrounds that aren't really ag specific. They might have an engineering degree, or they might, have an agronomy degree. So I would say start with, the things that you're comfortable, being sort of a subject matter expert at addressing, and the other, things that you don't know. I mean, phone a friend, call somebody who is an expert in trying to, unpack and understand those things. So yeah, kind of start with the things that you feel confident in addressing. And as you move on to the tougher ones, it just might take a little while longer. My other piece of advice, as you're looking at, some type of an undertaking, I always like to round my expenses up and round my income down. So I'm always trying to look at it in the worst case scenario. So, if I do that and I do a lot of research and I, round those expenses up and the income down and it still makes sense, well, it probably, has some merit.
Okay, we have a few questions. Have one on sometimes return on assets gets thrown around. How does that compare to ROI? And that's a good question. It does get used a lot. Well, one of the key differences is in the denominator of that formula. Instead of investment, it would be assets. And so assets would include, all the things you have invested in the farm. That's another kind of difference is ROI gets applied a lot of times to smaller projects or or little things like an input, whereas ROA is usually measured at the farm level. So it's a rate of return that we earn on all the assets employed in the farm. Whereas ROI, even at the farm level, is more of what you have invested, not all assets. So you would take out the debt side of it. It is basically what one of the differences, and you kind of usually hold the appreciation constant. Does that sound right, David?
Yeah. I think one of the takeaways here is that a lot of terms that sounds similar, and a lot of times people aren't using the same practices, and so you want to make sure that you have internal practices, and that if someone's trying to get you to make a decision based on one of these metrics, you challenge them with what were your assumptions and what were you using to come up with that. So they're important. The devil's in the details, as the saying goes. So we want to make sure that we understand the details.
Yeah, don't just assume that they're doing it the same way or the way you would do it, because that's may not be the case. I'll never forget, I was a new professor, and my secretary saw me leaving one. She says, "Well, where are you going?" I said, "Well, I've got class. I always have class at this time." And she says, "Oh, well, your colleague always told me you need to make sure and ask him where he's going when he leaves right before class, because you should not assume I'm going to class. I may have forgotten about it." So, I just never assume that it's right. I'm seeing another one. How do I unlock my farm equity to pursue higher ROI opportunities? What practical limits do lenders put on this type of loan? So it's a good question. For instance, saying, well, I've got some equity, I have some good opportunities. How do I tap that? And if you don't have the cash to pursue those, you usually have to take out a loan against those investments, and you're pledging your equity in order to do that. So that's how it gets done. You borrow the money. The lender is going to evaluate it. I'll let our lender weigh in eventually, but evaluate it based on what type of an investment it is. Is it something they can have a really solid collateral position on, or is it something that's a little bit harder to take as a collateral, how proven it is, and all of those other things, as well as the overall financial conditions. So ultimately, though, that's the answer is, if the equity is not in the form of cash that you can put in there, that's when we borrow money.
Yeah, Brent, I can chime in a little bit here. Yeah, I think you did well to hit on some of those things. So, each lender is probably a little different, and as far as how they're going to evaluate those things, how proven is it? How many dollars are you really investing? And then, if that investment would go poorly and you'd lose the whole thing, what is the end state? Could you afford to service that debt without any new income stream from that asset? So obviously it's a lot different, if you're buying something that, has value, even if somehow it doesn't work out, or if you're investing in to have a share in ownership in, some entity that's across the world or across the US that, could be bankrupt tomorrow and you have nothing to show for it. So, we maybe take a little bit of a conservative approach, and we look at it as, okay, let's assume no new income stream on this. If we're not really sure about, what this is, and, if it's feasible and it's not going to be a huge detriment to your operation, I mean, yeah, it's something we can do. But a lot of times, we may, the way we may, secure that from a lending perspective may be with bare farmland, or, your chattels, like your equipment and your livestock, just depending on what that investment exactly is.
So that'll do it for another episode of Two Economists and a Lender. Thank you, David, Brent, and John, for leading today's conversation. And for you in the audience, thank you for joining us. We'll look forward to seeing you online again next month.